All right, perfect. It's 5 p.m. Let's get going. Welcome everybody to the first session of this new series hosted by Vested called Think Like a Global Investor. And firstly, thank you so much for taking the time out to come join us today evening. We really hope that you learn something new in each and every session that we host, and hope that you can apply it now as more and more of you become global investors. At Vested, we really believe that we're at an inflection point in India, especially with relation to international investing. Now, an investor not only has access to mutual funds, has access to index ETFs, but also has access to direct investing, where somebody can open a brokerage account in the US sitting at home in just a matter of few minutes. And that is something that will change very much the landscape of how we invest here in India, and we're excited for that. For us, the mission at Vested is enabling sustainable wealth creation by allowing local investors to go global. So the format of the session for today is what we'll do is we'll have a presentation by our guest, and after the presentation, we'll open it up for questions and answers, and that will be moderated by me. In terms of my introduction, I'm Viram Shah. I'm the co-founder and CEO at Vested Finance. And so coming to the topic for today, and then I'll introduce our guest. The topic that we have today is basically understanding the power of asset allocation and diversification, especially using passive investing. So in terms of what is asset allocation, what is diversification, and what is passive investing. So just looking at those terms one by one, asset allocation, it's basically it's an investment technique which involves dividing your investment portfolio among various asset classes. And so you can look at asset allocation just from the point of view of investing in, say, stocks, bonds. You could also, cash is one of the assets, so you could also hold cash or invest into a different asset such as real estate. So that's where you, across different assets when you're investing, it's called allocating your assets. And this could vary as per the risk profile of every investor, as per the age of every investor. And then what is diversification, right? So asset allocation is essentially a part of diversification, where you're diversifying the assets you're holding. But diversification can also have multiple pillars. For example, there's geographic diversification, where now if you were investing just into the India markets, you could diversify geographically by investing in the same assets in another geography, say the US. So basically both of these concepts talk about how you divide your assets across a different kind of investment products to ensure that your risk-adjusted return is better. And lastly, talking about passive investing, the best way to describe passive investing is that it's not active. It's basically there's no fund manager behind a passive investment product that is actively picking stocks. It's either an ETF, an exchange-traded fund, or an index or an index fund that you would be investing when you're investing passively. And our speaker Koel will talk about both of these shortly. In terms of one of the key trends that we have seen in passive investing, so for the first time ever in the US, the funds invested in passive markets, in passive funds, has exceeded funds invested in the active markets. So in terms of active markets, it's typically mutual funds that we invest in India, whereas passive markets can be index funds or ETFs. And so the funds deposited in these passive funds has exceeded active in the US. And so it's definitely, passive investing is a trend that is worth noting. So getting into the introduction of our speaker, we have Koel Ghosh today. She has agreed to be part of this first episode of our series, and we're very thankful to her. In terms of Koel, her introduction, Koel is the regional head of South Asia for S&P Dow Jones Indices. And Koel leads the regional commercial efforts and actively educates and advocates for passive investing. She has contributed to the growing Indian asset management industry through her various stints at ILFS Mutual Fund and UTI Asset Management Company. She also worked at Thomson Reuters, where she further extended her business development skills in the financial data industry. Koel additionally heads up the business initiatives in India and serves as the managing director and CEO of Asia Index Private Limited, It's a BSC and S&P Dow Jones venture, and she was recognized by the AIWMI as one of the top 100 women in finance in India in 2019. And so now over to you, Koel. Just one quick note in terms of housekeeping. Please, if you have any questions, just drop them in the Q&A section so that we can keep them more organized instead of dropping them in the chat section. All right, perfect. Over to you, Koel.
Thank you, Viram. Thank you for the introduction, and good evening to everyone who's joined in today. Indeed, it's a pleasure to start working with Vested and introduce everyone to a different aspect of investing, which is passive investing, something I'm very, very passionate about. So I am looking forward to talking to everyone about it. So without further ado, I will share my screen with you so that we can start looking at this from a thing. So today, as Viram said, we wanted to talk about the power of asset allocation and diversification. Now, I understand that Viram has already given a thorough introduction, which is basically a foundation to what I'll be talking today to everyone about. But I think it's very important to understand, and I think it's very important from my end to also give that initial introduction, saying that I do understand India is an active market. A lot of people do like the direct investments. They do like mutual funds, but it is a reality, and that's what I'm going to be talking today about, that passive investing or index investing, as one would say, which is investing via the index funds or the index route, is something that is becoming very, very popular. So let me give this a bit of a background and give you a little bit of a trivia, saying that on 3rd of July, I don't know how many people know, but 3rd of July 1884, there was a rookie newspaper called Charles Dow, who decided to create the average of 9 railroad stocks and 2 industrial stocks to ensure that his newspaper sold well, and gave a basic gauge to the world about what that average would do in terms of how the markets are doing. Now, he set the stepping stone to what paved into the indexing world. Of course, years later, there were more indices that came out. And of course, 1975, Vanguard brought in the S&P 500. It gets good context as to where this indexing really started off and kicked off. And then I'm not going to read off the slides because I'm sure all of you all can. You can see how the entire indexing world started developing and growing out. And today it is more than a $5 trillion global industry. So index funds or index-based products are just not ETFs or index funds. You have index-linked options, you have structured products, you have insurance companies as well who are creating products based on indexing. It may be different from region to region. Typically, the US markets are far more developed than what the emerging markets are. But I think there is a huge catch-up game that started to coming up, where emerging markets are speedily catching up with the developed markets, learning and growing on this space. Now, just what I was talking about, if I take the March 2020 numbers, you can see that the way this asset management, the assets under this ETF space has grown out, more than 5 trillion, more than 7,000 ETFs. And if you see, it's a steep and high growing chart. So it is a growth which is worth recognizing. And as Viram said, the way it's growing out passive is starting to beat active. And I will try to say why this is also happening more and more. Now, if you go by region, just to give you a perspective, obviously, like I said, more developed markets are doing much better. You can see the US is almost 70%, and of which most of it is equity. Of course, Europe is playing catch up, and the other regions are slowly and steadily growing. Let's look at the India landscape. I mean, can you imagine? 2005, we were almost zilch, and now look at us. 86 products. This is $24 million, but I think we are far, far more. It's growing, and the way we are growing out is stupendous. It's a far more steeper curve. It's a much more exponential growth that we are seeing in this space. And I think while the India space is still nascent, there's a lot of education that people need. The infrastructure is we need to get better. But I think the way it's growing out, I think we will it'll be a very short time since we are playing a catch-up game with more developed world. So going on to, what Viram said, I just thought I'm not getting into the basics of active and passive. He's already covered that. Now, I think one of the things which, is always a continuous debate is, should I go passive? Should I go active? But active gives me more alpha. Passive doesn't give me alpha. Passive is only giving me index-based returns. Really? Now we do publish something called as SPIVA reports, and I'll be explaining this further. We are seeing that it is becoming a challenge for active funds to beat the benchmarks. Can you believe that? It's actually difficult for active funds to go and beat basic benchmarks. If I take US, it's the S&P 500. You take India, we use S&P BSE 100 because it's a much more broader index and you get a better understanding. And obviously, if you look at the pros and cons, higher cost structures in active funds, obviously there's fund management costs, there's research costs, there's trading costs, compared to a passive product, which is index based. So you're only rebalancing when the index rebalancing and you're basically following the index. There is an independent index provider, such as like us or MSCI or FTSE. They're all calculating based on certain methodologies. And that is allowing that product provider to just follow it to the T. Simple, you're getting index-based returns. And is it that bad? Then I'll show you some returns and you can, kind of understand whether, sometimes it's better to have a consistent returns on an average returns rather than really looking for that, kind of timing the market. I've always had this pet peeve in terms of, can we really time the market? Can we get that fund manager right? Can we get that fund scheme right? Can we get that stock right? Can we get it exactly right at the right time? I mean, if you're that good, of course, go ahead. Active is going to be. But, I think one has to realize that passive is a reality and you have to come to terms that it has to form a part of your entire asset allocation. Since today we are talking about asset allocation, should you put all your eggs in one basket or look at different strategies where you can actually ensure that you are, getting to your investment goals in the best possible way. Now, again, in India, there were a lot of mutual funds who were aligning, and now it's become very regular, but now all mutual funds are aligning them to total returns. But there was a point where, there were schemes that were aligning and showing the returns comparisons with price returns. Obviously, the same, it was not an apples to apples comparison. The regulator realized it, and today we are seeing that. And that is getting actually reflected in the SPIVA reports. So let me talk a little bit about what the SPIVA reports are. So the SPIVA scorecard is something that we have been now publishing for over 15 years. We, of course, started it in the more developed countries, and now we've moved on to other countries. There are 10 regions, as you see. It's an analysis that we do of certain categories of funds over the 1 year, 3 year, 5 year, 10 year, and 15 years. And what we are seeing as a part of this scorecard this is the latest one as of the year end 2019, and I will show you some more statistics. So this is just that. It's, of course, it's not always the case that active funds are outperformed by the benchmark. If you see the Mexico, you see US, you see Canada, Europe, Chile, these are the places where in the 1 year, 7 year, 5 year, if you see the numbers, let me take Canada. In the 1 year, 92% of active fund managers have been outperformed by the benchmark. So that's what the numbers here mean. But if you see in the last 1 year, in India, 40% of active fund managers were beaten by the benchmarks, which means that actually in the 1 year period, the active fund managers actually did well. So there are times and cases where the active fund managers do well, but we always say we invest for the long term. Look at the long term. 3 years and 8 year return, 84% of the active fund managers or the active funds have been beaten by the benchmark. 5 year, 82%. Now, let me give you a longer perspective. So if in India, we started publishing the SPIVA scorecard from the year 2013. So that's what I have done. And in the first few years, we didn't calculate the 10-year return. So you will see a little few empty bars on the 10-year arm. But if you see, most of the bars here are very clearly showing that they have crossed the 50% mark. So, the percentage of Indian equity, and this I want to highlight in the large cap space. I think the large cap space is almost a space where active fund managers are finding it more and more difficult to beat the benchmark. Worth giving it a thought, because the numbers are definitely saying that. You have 44 mutual funds. You have within that so many different schemes, and you have to sort fund managers. You have to sort schemes. I don't know, is it worth it? So, why not invest in the index? I think that's a much more simpler way of looking at it. Now, coming to the moot point, active or passive, which one do I go for? Why not both? This is why I'm presenting you to the core and satellite strategy. I'm sure a lot of you all know. For those who don't know, I'll quickly just run you through. It's a basically tactical model, and you have to decide what is your core. I believe in alpha. I believe I can invest in direct. I can choose that percentage of fund managers who are outperforming and doing well, giving the alpha. Your core has to be then, your portfolio and your thing. But what this strategy suggests is keep a buffer. Keep that satellite strategy, which will have your passive funds, your index-based funds. Because you know how markets are today. Look at the way COVID has completely changed the dimension of the way we look at markets, the way we look at businesses. So I think that's the time when a differential or a backup strategy also helps you balance your portfolio. So core satellite, I think, is very ideal, especially in markets like ours, where there is a certain level of people who believe active works for them. Very good, keep that as core. But if you say that, like for example, me, I'm a working professional. Do I always get the time to continuously track the markets, know which is the market? Do I have the patience to really go through all of that and see, okay, which is the best fund manager? Actually, no. So I, for that matter, would prefer to put most of my stuff in passive. But would I want to exploit some bit of the active strategy, which today is there? Maybe a small percentage. Yes, I'll put it in my satellite strategy. So that's how I'm kind of playing the core satellite out. Now going to, we talk about, Viram also spoke about diversification. Very important. We keep saying don't put all your eggs in one basket. You have to understand how different asset classes, different indices work. Now, we have a slew of indices. You have asset classes. Within asset classes, you have themes, you have strategies, you have different angles in which you can exploit. So within an index fund or within an index, investing strategy also, you can have a whole lot of them. Like today, if I'm just comparing, this is a quick comparison of an Indian equity. I'm comparing gold, I'm comparing Indian bonds, US markets, and crude. You can see all of them over a period of 1 year have performed completely different. And if you see in the last 6 months or 3 months, it's completely again different. Each of them have their variations in the way they are actually performing out. I'll give you a little longish strategy because that was a shorter graph. I just tried to put it into my presentation, but this is a broader perspective. It gives you the 1 month, 3 month, year to date, 1 year, 3 year, 5 year, and 10 year returns. So now you are getting a perspective of how each asset class is so different. Now, if you ask me, Koel, which one should I put in? Now that completely will depend on your understanding, how you want to play out your investment goal. What is your investment goal? Is it long-term, long-term investment gains? Is it short-term? Are you looking at trading? It's completely a different viewpoint from how you're going to approach. So individual strategies will vary, but what you have to understand is every asset class, every index has a different trajectory and the way it works. And that is something that you should always be careful about. Now, I just thought when I'm speaking about a larger variety, of course, I can't fill in everything. I had a mind of a lot of things I could put in today into this presentation, but I think time is the essence. And, as Viram says, we will want to even engage with you and understand what are your questions so that we can come back and, address more of what you guys want to hear about. So I thought I would pick up the US markets and especially what better an index to represent other than the S&P 500. Has been there for years. Return data goes back up to 1920s. Today, almost 11.2 trillion US dollars is benchmarked or indexed to the S&P 500. That's a lot of assets. And it's a very, very holistic index because it represents around 85% of the US markets. And it gives a fair exposure to your sectors. Now, if I have to look at it, of course, 50% of global equity markets, we have an index called the S&P Global BMI, which is a global index. And what we have seen is it actually accounts for over 24 trillion of that S&P Global BMI capitalization. If you see all the other regions, you can see how they pan out in terms of Japan is pretty much high. India has a fair small share in the entire global equity market, but the S&P 500 for that matter covers it all. So, when you are getting into an S&P 500, you're getting that kind of exposure. Now, I thought also let me give you some of the sector overview. Now you can see, and I'm comparing it with the S&P BSE 500, familiar with us in the Indian world. What the graph represents is the difference in sector weights. So you can see that there is a fair amount of difference in how you are getting into a different country, you're getting into a different region, you're getting into different sectors. So diversification completely there in all its way. So in terms of whether you are well diversified, that you can definitely tick that box off, because that definitely comes across in the way that we are currently doing. Of course, you can see how the differences work here. So again, I'm not reading out this slide, it's very self-explanatory. Again, going back to going back to our SPIVA scorecard, definitely the S&P 500 has also been hard to beat. If you see, even in the 1 year, 3 year, 5 year, 10 year, 15 years, active fund managers have found it very hard to beat the 500. Now the moot point here is, do I then get into individual US stocks if I'm looking at a US strategy, or should I just get into the 500? I think it's a simple answer that I think I don't have to really give here. Again, this is not something that I can only say for the past year. If you're seeing the majority of the active fund managers, if I take a 16-year data, barring those 3 gray bars that you're seeing here, you're seeing that active fund managers have basically underperformed the S&P 500. So what I'm trying to again make a point here is that looking at US markets, looking at markets per se, when you're looking at a market representative and not very specific, an index investing in my world, not only just because I am a part of an index fund, creator, provider, I really think that this makes sense. And the best part about this is that I am only creating the index. So I design, calculate, and maintain the index. I in no way can create products. The products are created by product providers of the world. So you have your BlackRocks, your SSGA, in Indian context, you have your mutual funds. So you have different product providers who are creating these products for you, and as investors, you have to approach them. So from my perspective, I'm completely neutral, I'm completely unbiased, and I have absolutely zero interest in how the product ultimately will turn out. What my perspective as an index provider is that I create an index which represents, if it's a market, the market, the strategy, if it's a certain kind of a factor, I'm representing that factor, and it is well represented through that basket of stocks. So if that basket of stocks is a true representation of what the index stands for, then you are in perspective buying a basket of what it represents. And it's easier than doing stock picking, I would imagine. So as a summary, passive is a growing space. So definitely merits inclusion in investment strategies. I think I just gave you a glimpse of the SPIVA scorecard, but you can go to our websites and download it, and you can see how this is a reality. Active fund managers are finding it tough and challenging to outperform these benchmarks. And There are advantages of this index investing. It is transparent. You can go to a website, you can go to an exchange, you can see the index numbers flashing, you see the methodologies published on the index provider's website. It is liquid, so if it's an ETF, it's constantly trading on the exchange platform. Definitely lower cost, because you are not you don't have fund manager costs. As I've said, there's no brokerage cost, there's no transaction cost, there's no research cost. And of course, it is giving you a diverse option, and it's well diversified. So you are not getting into there's no single stock sector exposure, and that helps you diversify your entire portfolio. And then finally, I mean, I realize reality. It's not a choice of active or passive. Core satellite is what one should actively engage in, so that you can get the best of both worlds. That's it from me, Viram.
Great. Thank you so much. That was very interesting, actually, especially the satellite strategy. That's not a way of diversification that I've ever thought of. And especially the diagrammic, if you put it out there as an illustration, as a diagram, it really hits home the point that you can have a core, and then around the core, you can have multiple sort of investment products around it. So super interesting. Thank you so much. And also presenting all the data. I think we have a few questions lined up. Before we get into that, I have a couple of things that I'd love to get your thoughts on.
Sure.
Yeah, and of course, I realize that because of your institution, you cannot give any advice. And so if any question is kind of going in that realm, then please feel free to just point it out, and then we can move on to the next one.
Yeah.
Perfect. I mean, the most top of mind question, I think you must be getting it all the time. The impact sort of how our today's environment, the COVID environment has had on the passive investing industry. And a sub question to that, does the way an investor thinks about diversification change in today's world, pre-COVID and post-COVID?
I think, and the way you're looking at investing should be standard. It is, you have an investment goal, and you are chugging towards it. It's how you want to play out your risk-reward ratio. Now, obviously, coming to COVID today, I think it's become more and more relevant in today's world that, are we in that things are so volatile that you can't, every minute you are reacting to a new change. Now, index investing, in that sense, you have the way the index has been performing. And then, like I said, I have taken the most simplest market benchmark. I've taken an S&P 500, I've taken a BSE Sensex or 100. Now, these are what we call as plain vanilla benchmarks. But what you have within the index world is you have factors. So what factors do is that they take certain fundamental aspects and we include that as a formula. So an index is nothing but it's a very standard formulated way of picking stocks. You just imagine yourself in one of those computer when we earlier learned DOS, if this is okay, then yes. If not, then no. So that's how we do it. So if one rule or one factor is kind of satisfied, we say yes, and then we say okay, fine, the stock is in. Now the way we are kind of looking at factors is there is low volatility, there is momentum, there is value, and there's quality. These factors have today in this world and in the COVID environment actually played out to people's advantage. Like low volatility stocks, what it does is in higher volatile times, it maintains a balance, and when the market goes really, it's stable, it again has a stability. So it will not give you very high returns when the markets are shooting up, and it will not dip you completely down when the markets are down. And what these kind of factors have produced as results is, over the long term, they have been seen to have more stable returns than the benchmark. And typically, past performance, of course, cannot be a definite testament to the future, but they have seen that these play out in a better fashion than the benchmark. So that is why you can actually get into these factor indices. Now, in these volatile times, if you're a really good stock picker, go out there and, there are the fund managers of the world who are doing it for their portfolios, fine, but I think as common investors, as more and more people look at strategy, index investing makes it much more simpler, because you're taking a complete strategy, uplifting it, blindly putting it in, because there is an index provider, like I said, who has thought it through, created the formula, and you're back, you're completely in business in what you're getting into.
Okay, got it.
Yeah.
Great. The fact that there's factors involved, that's an interesting concept. Cool. And just another thing I was curious about is from an AMC perspective, of course, passive investing lowers the fees that they can earn. What is in it for the AMCs to be launching these ETFs, especially in India, where the fees or expense ratios are typically high? Even in the US, mutual funds used to cost significantly higher fees. But now you've seen that in fact, all of the large ones are offering ETFs. So what needs to shift from an AMC perspective for them to know that, okay, they should be launching more ETFs?
Like I said, you're giving investors more choice. I think what drove the passive wave in India was actually government initiatives. So, the EPFO decided to invest in the Sensex and Nifty, started with 5% of incremental surplus, went on to 15% of incremental surplus. Then you had DPAM, who came up with, this unique way of disinvesting through ETFs. It kind of gave investors a flavor of passive, which earlier was not going through. I think we have a lot to thank the government for pushing that through. And I think now, like I said, SPIVA is kind of putting out, there are pockets like your large cap, where, I think the markets have regularized to a place where there is no more scope for an active fund manager to find more jewels. So it is that handful of stocks, it is those set of stocks, if they are brought together in a proper rule-based formula, you've got it right. You're going to get the same kind of, expectations and returns from those level of stocks that you would get from an active getting in and getting out. Sometimes trading works for you, sometimes it doesn't. So I think the best part of index investing, if I can use the language, is hassle-free. You're just getting into the basket. You can sit back and say, there I am in 30 stocks, and I can put my feet up.
Yeah, got it. Actually, that's a good segue to a question Mr. R.C. Nair had. And he mentioned something similar to what you were mentioning, where in India, the apart from the top 100 companies, there aren't a lot of other companies that are sort of meaningful in terms of market float. And so one of the things that he hinted at in his question is active fund managers get advantage information asymmetry. Basically, they might have more information in these 100 companies to be able to make better decisions. So really, apart from the Nifty 50 or the Nifty Next 50, which largely includes both large cap, they're not as deep as the S&P 500 is in the US. So would love to know your thoughts around that. Do you see the sort of indexes or indexes in India becoming more widespread, or is it just these that will be the more important ones?
See, I think the things we have to take account for is it's very nascent stage. I think the problem with India currently, and I would say we have come a long way from where we used to be, but we are still, I think there's a lot of investor education that one needs to do. Today also, I have been going around the country and talking to a lot of even direct investors, brokers. I think once they understand the power of index investing, they are going for it. So it is then again not, does somebody have the ability to do more? Of course, there are, like I said, there are different strategies. You have plain vanilla. Somebody can think, I will only invest in 100 stocks. Or somebody can say that I will invest in factors. I will invest in picking up low volatility. I will invest in quality. So I think the way we are looking at our markets is also changing. I don't think so. If before a Bharat 22 came or any CPSE index came, government didn't think about innovatively to think about, okay, divesting through an ETF. And people then got a pie of all these Navratna companies. So I think there are always opportunities. Each market is different. Today, our market may have a certain characteristics and Australian market may have a different characteristic. Every market works well with the benchmarks, the standard benchmarks, but there is a shift happening. slowly and steadily from the plain vanilla to then single factor indices, from single factor to multi-factor. So now a lot of people are not only looking at multi-factor, but multi-asset also. Why only use equity? You can use a mixture of equity and gold, given how and when that asset class will work out for you. So there are multi-asset allocation indices that we are creating for a lot of people. So I think that is where a lot of scope and opportunity lies. I mean, why can't we tomorrow do a US and India index, and then a person can allocate based on how the tide shifts. So I mean, I think there are a lot of ideas that one can generate through an index investing. You can sit here and be that decision maker in terms of your, like I said, for those people who like that active trend, okay, I want to make that decision, you can make it through indices, and it's far more easier to swap because you get constant information, and index has a pattern in the way it kind of keeps performing. There are trends, there is a standard rule. Yeah, you can always say the rule may be in some way sometimes hold you back because you may not be able to pick the right stock at the right time. But again, like I said, can you ever get market timing right? I mean, that's always a question.
Got it. There's an interesting question from Varun. Do you see an India equivalent to Vanguard coming up in the future?
Oh, I so hope so. I'm looking for that, Varun. Really, I am. Well, but I think what's happening is from the people who are realizing the potential of it are getting into it. I think it's a bit of a chicken and egg situation also, because the product providers want investors, and the investors want kind of more products. Like today, you wouldn't have imagined a US product in the market, but there are today people who are providing that. So I think slowly and steadily the market, I do see it maturing, because when I joined S&P 10 years ago, I mean, I walked into an active fund manager's cabin and I said, why don't you do index investing? And he was like, Koel, do you want to take my job? Because he saw index investing as a direct threat, because then he didn't have to do anything. It's just blind, putting it into an index. So, and then he doesn't get the steam. He doesn't get to do a lot of things. And it's a passive way of working. But that said, I'm saying I will not deny that there is always a value to an active investor. I will not take that away from things. There are active fund managers who have their own. And that's where I came to core and satellite. I think it is a wonderful tool, where you can pick and choose and ensure that, like even when I'm saying SPIVA report, the statistics do show. If I see today the 1 year return, we saw the active finance really get their act together in the 1 year return. So they did. There was a 60%. Now, if you want to catch that wave and you're prompt enough to get that wave, go for it. So I think or keep allocation. Today in asset allocation, you're already allocating between equity, fixed income, commodities, and international equities, or international any scope. You can always do that with a core and satellite.
Got it. Now the satellite, there are a couple of questions around that as well. I think people really resonate with that concept.
Yeah.
Parvati has a question. So you alluded a little bit to ETFs investing into the international markets also being available in India. And she asked, could you explain about tracking error in these index ETFs?
See, I think tracking error is something more relevant from a product provider side. But what happens is like, from what I can, with my limited knowledge, because I'm not on the product provider side, but the typical way is that if I have 100 rupees and I want to invest in a basket, there's always a bit of a cash component that's left, of which they have to adjust. Now, sometimes they do manage to adjust that, and the exact basket that they pick up may not be exactly a tie to tie. And sometimes the way they are transacting, how they transact, market realities in terms of when they are able to procure a basket and not able to procure a basket, may land up in terms of how aligned they can be with the index. So every index provider, every product provider tries to ensure that he is mapping the index absolutely T to T. But obviously, like I said, ground realities and transaction realities could be slightly different, and that at times could account for that tracking error, which at times is used also as a benchmark to understand how well or how well or closely that fund manager is managing to track that index.
Got it. Okay, thank you. I think a few people actually asked regarding the presentation. Is it going to be possible to share it?
Absolutely, absolutely. You can share.
Yeah. Okay, perfect. Yeah, there's quite a few people asking.
Sure.
Cool. Richa has a question. So she's mentioning that as a young professional, my friend suggests me to invest into mutual funds, which are 100% equity and not ETFs, and settle for market returns. So I think the core behind that question is you always feel like market returns are not enough. Like it's like you're not getting anything you're not getting a money's worth. So
Yeah.
I think that's a mindset shift that needs to happen, right?
So like I said, I mean, index can also offer that. I mean, that's where I started talking about factors. Obviously the presentation, I can definitely take people through more, details, but most of the, people who are today here can go into our website, which is us.spindices.com. You will see that there are various, we segregate our indices in different ways. Of course, by asset class, but also by strategy. So when you differentiating by strategy, you will see that there are multi-asset and multi-factor. I think one of the things that index providers realized is that, yes, one is, there are two ways we create our indices. One is to create a benchmark. So a portfolio manager has to understand how he is doing, how he's faring against what he is going for. So if a portfolio manager is going for an auto, he's focusing on auto, he needs something to benchmark to see how is auto sector doing. And that's what we do. Then we create a benchmark to ensure that he can, kind of benchmark it against what he is looking at. So he can see whether he's performing better or worse. And that's what a lot of mutual funds are doing. The other reason why we create is for product providers to be able to create these products. Now, obviously, the more products you have, you have a variety of appetite we are trying to, cater to. Some people are not, again, like I said, it depends on your risk reward strategy. It depends on how asset allocation, it depends on age. So when an investment advisor is doing your profiling, he will take all of this into account. So definitely, I mean, it's good that Parvati is thinking like this, because she should talk to an investment advisor who will then take her age into account, take what, her investable surplus into account, and then start allocating. Now, when you are allocating and you think that an index fund cannot give you better returns, I think that, or it cannot give you better than market returns, that's one thing that I want to debate. Because if you're looking at factor indices, I would suggest go look at low volatility, look at quality, look at momentum. There are different factors which then adapt the cyclical or defensive nature of the way markets are operating. And then they leverage on each of those and then come up with different, kind of return characteristics. I shared with you how a gold is different. Like today's world, we spoke about COVID. During COVID, people, there seems to be this rush. Of course, in India, we all love gold. So there's a rush for gold. So the gold prices are going up. So if you got in early right now, gold seems to be a good option. But do you want to get in like a timer? No. So again, if then it is how you want your returns. You can have a slab where, you are looking at market returns. You have market return indices. You want to take a different view on how you want to approach, how the stocks that you're getting into. If you want to base them on just not a market benchmark, but on certain factors, which then help you to pick out such stocks that will react in a certain way in certain market realities, I think that is a different way of it. One of the very interesting ones, which I think I can bring it to all attendees today, is ESG. ESG is becoming so popular. That's your environment, social, and corporate governance. Now, does it give you better returns? Maybe yes, maybe no, maybe same. But is the world coming to the fact that companies that are being more conscious about the environment, about social, about corporate governance, they want to, portfolio managers believe that these are the companies that you should support, and these are the companies who in the long term are going to be surviving, and they want to support that. That's happening. In the European countries, ESG is a big wave. There are certain portfolio managers, certain funds who will not invest in anything unless there's an ESG screen. Now, there is an S&P 500 ESG that we have recently launched, and that is also picking up in waves. Of course, India, we have an S&P BSE ESG index as well. So I think, but that's the thing, like, again, it's a chicken and egg situation. A product provider will think, unless there is a demand for it, I will not get into it. But it's about time where people are going to realize that these stocks are, and these companies who are taking added efforts to ensure that they are compliant and they are following extra cautious norms to see that they are, better companies and following certain ISO rules, etc., are in the long run could give you better returns. That is something we have to say. So I can't predict the future, but that is again another new concept that people are coming up with. So I think it's your risk reward appetite. If you change the style in which you want to invest, of course the risk element and the way you are going to expose yourself is going to be different, and that depends on, like I said, your investment advisor will work out a way and framework to get that done.
Yeah, no, ESG is very interesting. Given that Environment Day just recently passed by, we also wrote about it and how it's become quite a movement across the US and Europe, and in India also. Now there are surprisingly, I didn't know there are funds that are being launched in the ESG space as well. More active, of course, not passive, but that's interesting. And then the other point is that even in passive, there are flavors of active which you can get through factors, and so it's just not purely market. I think that is the mindset or thinking that needs to shift, that there's more to passive, and I think that's the point you're making. So thank you for that. Rochit has a good question. So this is something I've also always wondered. So he asks, in passive funds, how critical is expense ratio? So Vanguard has the lowest expense ratio, so greatest return. So this is the most important filter, right? I think the underlying kind of question is, what is the framework you should use when evaluating ETFs? Is expense ratio the only things you should look at? Or, of course, you mentioned factors, but are there other things that one should be aware of while evaluating ETFs?
Well, like I said, I don't think so. I'm the perfect person to give you that advice in terms of what are the factors when you are, because it's again a product related. But like I said, I think from an index perspective, when you are getting into any index investing concept, I think it's very important to see whether it marries with what your investment goals are. I think that forms the first criteria of what it is. Then you go into and see the methodology and see that, like I said, you're seeing the trends. So you can see how the index has performed over the years. You get the methodology, you see what it is. There are constituent details which you can see on the site, and you can know which are the stocks that they are getting into. So I think it gives you a fair understanding of what you're getting into. But I think overall, it depends on your strategy as to how you want to get to what you want to get. Now, any kind of comparison in terms of which ETF to use and what ETF to use, again, I would say today there are a host of investment advisors who are doing an incredible job. There is a new, I think there is a new upcoming registered investment advisors as well, who are very, very equipped. There are a lot of online portals, etc., who are offering advice. I think it is good to do the research. Get yourself an investment advisor, and then I think then get into it, because they will really help you guide into what you should get into, how you should get into, and actually it is very important to profile you. So they profile you to understand what is your requirement. I may think I want to get into a very, very active and a very aggressive strategy. He may, through his experience as an investment advisor, have a very different viewpoint and explain it to me. So I think it's very, very important to go through the right channels.
Got it. And sort of talking about creating a diversified portfolio, do you have any sort of thoughts on how one can look at doing that? Or is it still more, it's more individual specific and investment advisor dependent?
Yeah, I think, like you said, diversification is critical, because you should not, in times like this, also COVID, right? You're seeing how assets completely differ in terms of how they perform. You may find a fixed income and a gold much more steadier than how an equity performs. But then again, if you are in a very different frame of mind and you're able to, strategize in terms of how you are getting into a certain equity strategy, that is a very different way of approaching it. But yeah, my overall sense of diversification is it is good to spread out in terms of rather than be a concentration into anything specific. I think having a certain, and then again, it depends on, like, a younger, like I said, a younger professional can take certain risks, which, I could be different. A person who's just starting his career may have a lot of surplus funds, which he may not have a family, he may not have commitments. People, as they get married, have children, they have a different sense of, way in terms of how their goals are aligned. I think it really comes back to what stage of life you're in. And I think that's where, it really does come back to, I'm repeating myself, does come back to an investment advisor, because they are very, very critical. It depends on, there's not one shoe that fits all or one size that fits all. You have to cater it and you have to make it conducive to what is suitable for you.
Got it. Understood. There's also a question, do you have any reading or any recommendation on where someone can go and learn more about passive investing? I think there's a lot of jargon that is might be new for somebody who's just getting started. So is there some resources that you would recommend?
Yeah, so I think you should definitely go to our website. We create a lot of content on passive. So from the US perspective, we have the us.snpindices.com. That will give you a lot of the global perspective. If you are looking at the India perspective, please do visit. We have the S&P BSE collaboration, which is called Asia Index. So that website is www.asiaindex.co.in. And you must go to a blog that we think. So if you just Google indexologyblog.com, there is a lot of content that we constantly keep putting out in terms of, what is relevant not only for India but for global. And under the COVID environment, S&P has been creating a host of content on indices, strategies, and I think it's very enriching. In fact, I enjoy reading that as well. So that is definitely there. And like I said, today I can definitely, if for those who are interested, I can definitely do a more basic kind of an approach. Today, my approach was more that like I said, I thought that a lot of the attendees probably would already know some, things. But, there is actually no shame, because I have gone, and passive is completely a new concept for a lot of people. I'm in the business, so I understand. But I can talk to my doctor. If I talk to my, neighbor, they don't understand what is passive. So it is very difficult. I literally once had to explain to them, like, you remember Diwali box, and they said, what is an index and how do you differentiate? So I said, okay, you take a Diwali chocolate box. There is some dark chocolate, there's some white chocolate, there's some nuts. So you have all different things, and that's how it makes a box. So your box is your index, and individual stocks can be different. So there are different ways you can explain. And and it's very simple. And actually, once the person understands how beneficial index investing is, they're completely clued on, because it's so simple. And I think today the fact that it's not got popular in India is that a lot of people have not understood the benefits of it. They've not understood the fact that it's so transparent. They've not understood that you're getting into a basket of stocks which is automatically sector diverse. It doesn't have concentration risk. You're getting into a low cost option. There are two ways you can get into it. You can get into it via the stock market, which is through ETFs, right? There's constant trading happening. So you can actually get in and get out at any point of time. So if somebody says, okay, I don't want to get into an index fund, which is a mutual fund where you can only buy and sell at day end, but I want to have a much more fluid price, you can go into the stock markets and do it. In fact, ETFs do require more liquidity. Today, one of the challenges that we are facing in India is that we do need liquidity in the ETF market. There is a bid-ask spread, which some people do not like, but cat and it's the same thing.
It goes round and round.
Who gets there first? Will the investor get there in first, or will the trading get in first? So I think if the trading gets more popular, people start getting out, you will get more fairer prices that are coming through. And plus, in India, one of the biggest advantages, you can, if you have a bigger kind of quantum, you can actually go and buy straight from the asset manager or the mutual fund house or the in a lot of global markets, you have to go through the intermediary. So I think today you have that benefit as well. So people who have a lot or have bigger funds to invest in can get in through that. But I mean, personally, I think the index investing gives people an opportunity to get that index-based returns. Doesn't have to be just market returns. It can be a different strategy as well. But like I said, you need to try it to understand the benefits of it.
Got it. Yeah, there was a question around index mutual funds versus index ETFs. I think you answered that in the process. Yeah. It's more around liquidity that the ETF provides. And if there's any other points you'd add to that, let me know.
No, I mean, that's it. It's more like a mutual fund you're getting in. And one of the things I think which is probably missed out, and it's in our world, in India, it's for some people it's relevant. You do require a demat account in ETF. In mutual funds, you don't need that. So for some people, that becomes a problem. So then they get into an index fund. And, obviously, if your ETF is like a share, so you will need a demat account. So that's one of the differences that is very prevalent.
Got it. Okay. Understood. And I think the last question is, are there any risks that anybody should be aware of while looking at passive investing?
Well, I think it's you're getting into investing. It's you have the standard
market risk, yeah.
So I think whenever you're exposing yourself to any kind of asset class, I think we've seen that even fixed income has its fair share of risks.
Yeah.
So one has to kind of think. I mean, I think I really contest the idea that if you want to keep your money safe, just keep it in the bank, because what people don't realize is there is an inflation number that you have to take into account. So take your savings, return or interest and deduct that inflation amount and then see what you're getting in hand. That's your real return. So, I mean, a lot of people don't do, they think, oh, bank is the safe, bank deposits are the same, safest zone. I think that we have to wonder that in terms of, whether this is versus market linked versus bank deposits. So again, you have different options. Again, it's a matter of like coming back to asset allocation. You do not need to put all the eggs in one basket. People do have preferences. Some people do like that the bank interaction and the experience that they get from a banking product. So definitely you can place it that way, but always like I said, we can choose as to how we spread it out based on how your investment goals are. So talk to your investment advisor.
Perfect. Okay, great. That's it. So that brings us to a wrap for this session. Thank you everybody for tuning in. Thank you, Koel, so much for taking your time out and answering patiently all of the questions that came up. And we will definitely share the presentation. This series will also be available on YouTube. So anybody who wants to tune in later can do that. And apologies if I missed questions. There were a bunch of them which I couldn't really get to. And it's good to see some of the vested regulars asking questions. It's always encouraging to see all our users signing up. And so I hope it gave some kind of additional knowledge. You took away something new today in terms of passive investing. And thanks everybody. Thanks, Koel. Have a good evening.
Thank you. Thanks for having me. Bye.
Bye.